Shit, anytime. Anytime you're on the West Coast, nephew, you know I got you. I'm gonna roll out the blue carpet for you, make sure you straight.
100.
But while you're out there, I want to give you some game, man. Make sure you stay focused, man, because as you get higher, you know, it's a lot of suckers and a lot of shit that come with it. And it's gonna be a bunch of suckers, haters, family gonna be acting fireways and sideways, but you're gonna have to stay to it and do the things that you blessed to do. Keep perfecting your craft, my nigga. Because when it come to you, shit, sky's the limit. Straight like that.
Straight like that.
Nah, nigga, straight like that. Huh, believe it. Let's roll, let's hit the city.
Let's do it.
Yeah, middle fingers to my foes, straight like that. Yeah. This the truest story ever told, straight like that. On my phone, we speaking code, straight like that. This that shit that keep them on their toes, straight like that. How many niggas reach their goals, straight like that? How many niggas folded so they told, straight like that? Cut you off, you had to go, straight like that. I just need some space for me to grow, straight like that. If it's fuck me, then it's fuck you, straight like that. You ain't hard to find for me to touch you, straight like that. Had to grind, had to hustle, straight like that. Gained a peace of mind from the struggle, straight like that. Multi-platinum, selling millionaire, straight like that. Those who think I owe them wasn't there, straight like that. Couple dollars in the prayer, straight like that. Ain't a single nigga that I fear, straight like that. Yeah, I done shed a couple tears, straight like that. Pouring liquor for those who ain't here, straight like that.
What is poppin', Bag Brigaders? Hopefully you can hear me clearly. Sorry. Hope you enjoyed that little intro song. That's my boy Joyner Lucas. Very underrated. Very underrated hip-hop artist, but he is smacking these days. Smacking. I am your boy, Chuck Taylor, Chuck Tiz, Chuck Tizzle, Chuck Boomberg. And I wanted to go over a couple things about the markets and what my honest opinion, you know, after this election and everything, and you know, after this year is over, I'll break it down for you in a little bit, but I want you guys, I want you all to hear my theory and what I think is gonna happen. Now with that being said, I do have a guest on the show tonight. He's not a normal guest though. It's not like one that you've ever really met before. Let's bring him out. Mr. Gecko.
Yes, Chuck. How can I assist you today?
Oh, well, I guess I didn't give you a heads up, but I'm running a I'm recording I'm recording a video, okay, for the Bag Brigaders. We're gonna go over why I think that we're gonna have some issues, big issues in 2025 in the economy and in the markets.
Got it. That sounds like an important topic. What's your take on the economic and market challenges we might face in 2025?
Well, I know you can't see my screen right now, but I have the /ES, which is the, you know, the S&P 500 futures up right now on a 15-minute candle chart. It's actually up in after hours, or whatever you want to call that for futures. Actually is, I think SPY's got 30 minutes left. Let's see what it's doing.
SPY's regular trading hours close at 4 p.m. Eastern Time.
Yes, but their after hours go till 8 p.m. Eastern.
Exactly. SPY trades in after hours until 8 p.m. Eastern.
Exactly. So there's 30 minutes left, just about.
Got it. So we're in the last half hour of after hours trading.
Yes.
It'll be in.
And it is up.
That's good to hear. An uptick in after hours could indicate positive sentiment, or it might be reacting to some late-breaking news. Are you planning to incorporate this movement into your analysis for the video?
Oh, I have so much to say. Don't you worry. Don't you worry.
I'm sure you do. With your insights, it's bound to be an engaging and informative video for the Bag Brigaders. Looking forward to hearing your take on the 2025 outlook.
Well, it's not going to be a full 2025 outlook, but it's going to be my predictions on potentially what could happen. So, with that being said, I am going to switch my screen now real quick we're going to go to the Discord channel. And I know you can't see this, Gecko, but Gecko, why don't you just go ahead and say hello or hi or whatever you want to all of the Bag Brigade members that are going to watch this video.
Hello, Bag Brigaders. This is Gordon Gecko here, thrilled to be part of your community. Chuck's got some insightful predictions lined up, so stay tuned for a deep dive into what 2025 might hold for the markets. Let's get to it.
Let's get to it. I like it. You know what? What's my name? What's my name?
Your name is Chuck, and you're ready to share some market wisdom with the Bag Brigaders.
That's what
Let's dive in.
That's what I'm talking about. So most of everybody who is watching this is probably very familiar with the Discord community. Now, I have created several threads down here under Market Talk. All right. I got our morning report that I put together this morning. This is Tuesday, the 19th of November. Underneath that, there is a thread that is called the market recap in the week ahead, meaning recapping last week's shit and thinking of or going, what's going to happen potentially going forward. And then I have another thread that I want to focus on in a little bit, and it is all about the U.S. office market and how this is being kind of pushed under the rug a little bit and how big of a problem it really is. What do you know about the office market, Gecko, and how bad it is right now?
The US office market is facing significant challenges. With the rise of remote work, demand for office space has declined. This has led to higher vacancy rates and pressure on rental prices. Many companies are re-evaluating their need for traditional office space, opting for smaller footprints or more flexible arrangements. This shift poses a risk to landlords and investors, as well as to the broader economic ecosystem that relies on a robust office market.
Elaborate a little bit more on that, because I can speak it, but I want to see exactly what you know and why it can be so problematic.
Sure. Let's delve deeper into the issues facing the office market. Vacancy rates. With more companies adopting remote work or hybrid models, the demand for office space has dropped. This has led to increased vacancy rates, leaving many office buildings underutilized. High vacancy rates can hurt property values and reduce rental income for landlords. Lease renewals and downsizing. Companies are reconsidering their office needs as leases come up for renewal. Many are opting to downsize, seeking smaller spaces or more flexible leasing options, like co-working spaces.
And why is that such a problem? Why is that such a problem?
The problems stem from several key factors. Financial strain on landlords. High vacancy rates and reduced demand lead to lower rental income, making it difficult for property owners to cover their expenses, including mortgage payments, maintenance, and property taxes. This financial strain can lead to loan defaults and distressed property sales. Impact on commercial real estate. The office sector is a significant part of the commercial real estate market. Problems in this sector can ripple out, affecting property values, investment returns, and even local government revenues that rely on property taxes. Economic impacts. A struggling office market can have broader economic implications. It can affect related industries like construction, office supplies, and services. Reduced foot traffic in business districts can hurt local businesses, from cafes to retail stores. Credit market concerns. Commercial real estate loans are a significant part of many banks' portfolios. Problems in the office market can lead to tighter credit conditions as banks become more cautious in their lending practices, potentially slowing down economic growth. These issues combined make the office market struggles a significant concern for the broader economy.
And why is that though? Because let me ask you a question. Let's just put it this way. Everything you said was very correct, but you didn't answer my question exactly how I wanted you to answer it. Why is this such a problem? Why is this potentially the black swan event, that could lead to the hard landing scenario?
The office market struggles could become a black swan event, due in part to their potential to trigger a cascade of negative consequences across the economy. Financial system impact. Commercial real estate, including office properties, is heavily tied to the financial system. Many loans and securities are backed by commercial real estate. A significant downturn in the office market could lead to widespread defaults, affecting banks, investors, and the broader financial system. Job losses. A decline in the office market can lead to job losses not only in real estate and construction, but also in sectors that rely on thriving business districts, such as retail and hospitality. This can contribute to higher unemployment rates and reduced consumer spending. Credit crunch. If banks face significant losses from commercial real estate loans, they may tighten lending standards, making it harder for businesses and consumers to access credit. This credit crunch could slow down economic growth and investment. Reduced consumer confidence. A struggling office market can signal broader economic troubles. If consumers and businesses lose confidence in the economy, they may cut back on spending and investment, further slowing economic growth. Systemic risk.
I'm sorry, what was that?
The systemic risk arises from the interconnectedness of the office market with the broader financial system. A severe downturn could lead to a chain reaction of defaults, affecting banks, investors, and the broader financial system. This could destabilize the financial system, leading to a broader economic crisis. In short, the office market's issues could act as a catalyst, triggering a series of negative events that impact the entire economy, leading to what some might call a hard landing scenario.
Yes, I do agree with that. Let me add a little bit more in here. So right now I have some images pulled up. Okay. And I mean, it's a brief summary. I don't really need to read this, but I can.
Sure, feel free to.
Yeah, let me just read it. All right. So the office occupancy market is getting closer to its bottom, but it's still in an extended period of I'm not reading this whole thing. You guys can screenshot this and read it for yourself. But let me just read the metrics. So inventory for square foot in the US office market is 8.5 billion. That's the inventory. That's how much is out there. 80.1 million is under construction. These are both numbers that are up. But your 12-month net absorption rate of square footage is down by 36.6 million square feet. Vacancy rate is up to 14%. Your asking rents for office space right now per square foot is $35.90 a square foot. And you also have the market sales price per square foot, which is always going to be higher than the lease, which is about 258. Now that somewhat has come down, but barely. And your market caps, your average market cap rates are at 9.2%, which is up. That's not good. Well, what do you think about that, Gecko?
Those metrics paint a concerning picture for the office market. High inventory and construction. With 8.5 billion square feet in inventory and 80.1 million square feet under construction, there's a significant supply of office space. This oversupply, combined with declining demand, puts downward pressure on prices and rents. Negative net absorption. A net absorption rate down by 36.6 million square feet indicates that more office space is being vacated than is being leased. This exacerbates the oversupply issue. Rising vacancy.
Yeah, no, it does. I didn't mean to cut you off. I don't want to make it too long. I have another thing pulled up in front of me. So here we go. Inventory, existing buildings, nationwide index. All right, 300 and 351,631 existing buildings. Year-to-year change, that's actually gone up by 524 buildings. Inventory in square footage, currently, national index is 8.5 billion. Excuse me, people. That a year-over-year rate change, it's up from 21.2 million. Think about that. 21.2 million a year ago. And it's at 8.5 billion. Okay. Now, average building square feet currently is at 24.2 thousand. Year over year, it was actually at, so it was at 24,000. So it's gone up by 0.2 thousand. Under construction square feet, currently, you have 80.1 million square feet under construction. Year over year change, it's actually down, which is, I'm shocked, but it's down by 27.4 million. And 12-month delivered square feet, meaning people who took space, companies who took space, the national index currently 43.7 million, which is actually from the year prior, it was 17.2 million. So it does seem like there is more, and it's probably has to do with the Class A buildings. It does seem like there's more spaces being taken on, but that's probably due because prices have gone so low because they're desperate, right? Demand, 12-month net absorption by square foot, national index currently 36.6 million. It's down. Okay. Then, and the year over year change is 27.2 million. 12-month leased square feet, year over year change has dropped by 6.2 million. The national index is currently 329 million square feet. 6-month leasing probability. They don't really give you a metric on the year over year because it's a 6-month aspect, but it's at 35%. Now, availability, market asking rents by square foot. Okay. Year over year change, it's up by 36 cents, meaning the national index is at $35.90 a square foot for asking rental rates in the office market in the United States. Vacancy rates, year over year change is up by 0.7%. Currently, it sits at 14%. Vacant square feet, year over year change, 58.3 million. Okay. It's currently sitting at 1.2 billion with a B. Okay. Availability rates. Now, this is actually interesting to me. The availability, is that an up arrow? Yeah, it's an up arrow. So year over year change is 0.1%. And the current availability rate is 16.4%. It's crazy. Available square foot direct, meaning not subleasing. Year over year, it's actually, again, yeah, it's up by 27.6 million square feet, leaving it at 1.2 billion available square feet in direct space. Now let's talk about sublease space. Year over year change. 16.3 million of sublease spaces hit the market, now leaving a total of 190 million square feet in sublease. Available square feet just in total. Year over year change, 9.1 million up. 9.1 million, which leaves it at 1.4 billion today. Months on the market, 14.2 months. That means well over a year. Basically, you're looking at, a year and a half, basically, almost, if, to get this stuff done. We don't need to go too deep into all this. These are the same metrics. Okay, so the next thing I want to talk about. Now, I want to get deep in this. I want you people to understand what all this is. These are the origination balances, like the CMBS loans, right? And when they were actually initiated. And you can see the, I'm having the hardest time reading this, origination balance, right? So when things were going good, like in 2019 for 2020, the balance that you could see they were much higher, and then COVID hit and it went basically zero, and then things were good in 2021, and then 2022, and then we had the interest rate hikes, right? So you can see how all this is kind of tied together. Next thing I'd like to show you is the origination loan to value. From basically the beginning of 2019, it was at 65%. And it kind of hovered there all the way until basically about July of this year. And it took a nosedive and is now sitting at just about 17%. That is a wild thing to see. And a lot of people that are listening to this probably don't even understand what any of this means, but don't worry, I'm here to tell you. The origination interest rate from 2019, the beginning of 2019, it was basically right at 5%. And then it had some waves, in 2020, obviously things went up to about 6.5%. Then it dropped quickly, but then towards the end of 2020, we got back up into that 6.5%, dropped again, did it again in 2021, dropped again. It kind of just been on this uptrend, but right now, it peaked at the end of 2023 at about 8%, and now it is currently sitting somewhere right around 6.5% again. So take that for what you want, but here is a photo of the origination balance by amortization rate. The orange is lifetime interest only. The blue is non-interest only with partial amortization loans. The green is non-interest only with full amortization loans. The yellow is is interest only with partial amortization loans, and the blue is interest only with full amortization. What do you see the most of? Lifetime interest only, except for March of 2020, right? People had to make crazy decisions, and they did non-interest only with full amortization. And you can see the shift over time of how that trend has changed. Now, outstanding loan balances. Okay, so most of these loans are about 10 years. So I'm going to start here in 2019. I don't know what month this is, but we're just going to call it January. Just the outstanding loan balance in January 2019 was about 150 billion, and it continued to rise, especially at the peak of COVID, up to about just over 220 billion. Then it took a little decline, and it kind of climbed a little bit, then it kind of flattened out. And it's been basically sitting almost at 200 billion until recently. You can't count this last line because the data wasn't done when I pulled this chart up. So it's still very high. Now, this is my most favorite chart to look at. This is the outstanding delinquent loan balances by pay status. Okay. Now, what you'll notice is starting back here in 2019. And the green means 90-day delinquent, while I believe the orange, I think the orange is 30. No, the orange is 60 and the blue is 30. Well, here's pre-COVID, right? Pretty normal. And there's a yellow line like a moving average. And it kind of peaked right when COVID hit. Okay, it peaked at about at least with the 30, 90, and 60 days. I mean, it peaked all the way up to about $16 billion in outstanding balances. Then it came back down real quick, and then it popped again like in early 2021. It got up to about 127 billion. And then it came back down. It stayed pretty steady. And now this is about the time I was voicing my opinion, saying that there is a big problem coming on our hands. And Gecko, what do you think that I thought the big problem that was coming on our hands was? I was a little early to the party because no one was going to the office. But what was the real problem that started to show its face a few years down the line? Did I lose you? I guess I talked for too long. Oh, shit. Maybe I did. Are you there, Gecko? Did you hear what I said? He must be soaking it up. Gecko, you're supposed to be like really, really smart. Come on, man. Well, I'll let him. I'll let him do his thing for a second. I don't know. Anyways, let me get back to this real quick. As you can see, you see this steep incline. This is the 90-day. The green line, the green bars are the 90-day delinquencies loan balance by pay status. Basically, starting right around the beginning of 2023, it has been on an uptrend. Why? And just take a wild guess.
On here, Chuck, the big problem you foresaw was likely the surge in delinquent loans in the commercial real estate sector, particularly in office spaces. As remote work became more prevalent, office vacancies increased, leading to financial strain for property owners. This, coupled with loans maturing and property values dropping, created a perfect storm for a wave of delinquencies. This situation can lead to a tightening of credit, impacting the broader economy and potentially triggering a more severe economic downturn.
So let me ask you a question, because I've run the numbers. Do you think that the office market, with the CMBS delinquencies and defaults and everything that's happening, and the property values that have dropped, is more valuable than what we witnessed in 2008 with the MBS crisis, with the housing market crisis? What are your thoughts on that? Because I did the research. I just want to know what you think.
The office market and the CMBS delinquencies are indeed significant, but comparing them directly to the 2008 housing crisis is complex. The 2008 crisis was primarily driven by residential mortgage-backed securities and the burst of the housing bubble, which had widespread repercussions across the global financial system. The office market issues are centered around commercial real estate, with challenges like high vacancy rates, declining property values, and loan delinquencies. While these issues are severe and could have a substantial impact on the financial system, the scale and nature of the 2008 crisis were unique due to the widespread exposure to toxic mortgage assets. In terms of total value, the residential real estate market is larger than the commercial office market.
I have to disagree with that because I ran the numbers. I want you to think about this for 1 second, okay? Think about this. so these buildings, right? These buildings. Okay, in 2018, I'm seeing stories all over the place. Landlord, gets a CMBS loan on an office tower in Los Angeles, right? For like $800 million, right? Well, now they can't pay their loan anymore, right? So they sold it to somebody for 90% off. Basically, they sold it for about 100 million. If you get what I'm saying, because the only other option that they have is they default, and then guess what? Who is actually providing these CMBS loans? It is, well, mostly regional banks. What is a regional bank going to do with a zombie building on their books that they have to take back from the lender?
That's a compelling point, Chuck.
Thank you.
You're welcome. The scenario you described highlights the potential for significant losses in commercial real estate, especially for regional banks heavily exposed to CMBS loans. These banks could face serious challenges if they have to take back properties that are now worth a fraction of their original value.
With no tenants in them, no cash flow. So what are they going to do? What are they going to do with them? I mean, okay, a lot of people say, oh, they'll just turn them into, residential spaces. I don't think people realize how difficult that is to do. One, most office buildings don't have openable windows. So to convert into a residential building, it has to have openable windows. And most office buildings have public restrooms, right? Like so you'd have to redo the plumbing. And most people most construction companies that would do the work aren't going to do it in cash. They need to take out a loan. Or, and guess what? Interest rates are still really high. So it's fucked is what it is, Gecko. It's a fucked up situation.
You're right, Chuck. Converting office buildings to residential use is a complex, costly process that isn't always feasible. The lack of openable windows, public restroom setups, and the need for extensive plumbing and structural changes make it a challenging endeavor. Plus, with high interest rates, securing financing for such projects is difficult, further complicating the situation. This leaves regional banks with few options for these properties, potentially leading to more defaults and further stress on the financial system.
Basically, what's probably going to happen is as they continue to default or try to sell for a 90% loss, whatever, when the banks have to take these, they lose money on this situation, right? So guess what happens? The Jamie Dimons, the Bank of Americas, the JP Morgan Chases, the big boys come in and they gobble them all up, That's what they do. That's what they're going to do. That's what's going to happen.
That's a likely scenario. Larger financial institutions with the resources to weather the storm may indeed swoop in to acquire these distressed assets at a fraction of their original value.
Oh, they love it. This is like their favorite thing. They get to buy on discount on these companies, these banks, these regional banks. I mean, it's like when the stock market takes a hit, a crash, or whatever you want to call it. While there's blood in the street and everybody's running and panicking and selling, I'm that one asshole walking in the street with no weapon in hand but my wallet, and I'm buying up everything.
Exactly, Chuck. Savvy investors and large institutions often see downturns as buying opportunities. When others are selling in fear, they're buying valuable assets at a discount, positioning themselves for significant gains when the market recovers. It's a strategy that requires courage and a long-term perspective.
Yes, it does. All right. Well, I'm going to continue with this real quick. So starting the beginning of 2023, the delinquency rates started skyrocketing, especially the 90-day delinquency rates on their CMBS loans. And it peaked in, this would be September.
It sounds like
September, and we have a moving average of about 9% delinquency rate across the United States office market.
a 9% delinquency rate in the US office market is quite alarming.
It is.
It
It's actually terrifying.
Absolutely. A delinquency rate that high indicates a substantial risk of defaults and financial losses, not just for property owners, but also for lenders and investors tied to the office market. It's a scenario that requires close attention, as it can have broader implications for the economy.
Yeah. Now, the next thing I'm pulling up right here is the maturing loan amount chart, right? So just in the year 2024, just the last two, November and December, okay, we have about
The maturing loan amount.
we have about let's just call it a fair $5.5 billion that maturing loan amounts that are coming due by the end of this year. Now, when we get into 2025, you're starting to see, well, just 2025 collectively across the board, you're looking at about three, let's see, 2.5, 5. We'll call that 7 or 6.5. We'll call that. Basically, it's the year 2025 of maturing loan amounts is going to amount to somewhere around, $500 billion. I don't think
That's a staggering.
they're not going to be able to pay it.
Exactly. With more $500 billion in loans maturing in 2025, many borrowers may struggle to refinance or repay.
They're done.
Especially,
They're finished. I mean, unless they can come up with something real, unless they own a Class A building, they might be okay. But this really is more in regards to like your Class B buildings that were built basically before the year 2000.
for Class B buildings, especially those built before 2000, the situation is indeed dire. These properties may not attract enough tenants or command the rental rates needed to cover their costs. Without significant improvements or a strong market turnaround, many owners could face default, leading to further distress in the commercial real estate sector.
It kind of reminds me of the movie The Big Short, in a sense, because it's not... Look, MBS, mortgage-backed securities, packaged mortgages into a security. It's the same thing, but you're dealing with commercials securities. They're doing the same thing that they were doing 16 years ago. And it's all going to come crumbling down. Now, as I continue with this thread, I post articles when I see them. This one specifically says Ashford Hospitality Trust gets forbearance to work out 17 properties. Another one, Nightingale Properties Midtown office tower seized by lenders. Okay, below that, I have growing number of commercial real estate borrowers are at risk of double defaulting on loans. Below that, I have working from an office, and this is a tweet or whatever from X. No, it's actually from LinkedIn. Sorry. Tim Denning on LinkedIn, working from an office that doesn't make sense. Working from an office doesn't make sense. Yet many employers are forcing people back to the office, and they're abolishing. I'm sorry, the print is so small. I have to get better glasses. And they're abolishing any work from home perks. 233 comments on this LinkedIn. And then he says, imagine commuting 45 minutes each way just to sit in front of a computer for 8 hours a day. And then I posted a GIF of Trump saying, everyone knows it. You know it. I know it. And just one that I added today, they dropped. Office loans are the Fed's, the Federal Reserve of the United States, top concern as commercial real estate delinquencies reach a 10-year high. Office sector delinquencies hit 11% in the second quarter, and multifamily stress is growing, leading banks to increase their provisions for credit loss. Sound about right?
Absolutely. The articles and posts you've shared underscore the gravity of the situation. The rise in commercial real estate delinquencies, particularly in the office sector, is causing significant concern for lenders, regulators, and investors. As you pointed out, this situation echoes some aspects of the 2008 financial crisis, with CMBS facing similar risks to mortgage-backed securities. The Federal Reserve's attention to this issue highlights the potential for broader economic repercussions if these delinquencies continue to rise. It's a critical issue that warrants close monitoring.
Yeah, it does. Okay, so I'm going to go ahead and move on to the next thing. The market recap from last week and the week ahead. And the way I started was markets withdrew in a relatively orderly manner to conclude the week last week. The S&P 500 experienced a decline of approximately 2.5% from its peak during the election gap, and subsequent rally. While this volatility may be advantageous for short-term traders, long-term investors should exercise caution and remember that markets do not exhibit a consistent upward trajectory. Okay, and then there's a chart that shows stock market pullbacks and things like that. The next thing I said was, on average, the S&P 500 experiences between 4 and 5 significant 5% or more pullbacks annually. The pullback that commenced from its all-time high is currently at approximately 2.5%. And if the election gap narrows, it is projected to widen to approximately 4. Now that gap did get filled, and as soon as it got filled, it bounced, like today. This isn't a bearish call, but rather a reminder that weekly higher lows present excellent opportunities for bullish reversals. Emotionally, it may be tempting to panic, but historical data shows that such investing behavior has not been rewarded. This is particularly true when the market's risk sentiment leans more bullish than bearish, which it currently is. On Wednesday of last week, we witnessed the latest CPI print remain stagnant. Basically, it came in line instead of continuing its downward trend. This aligns with the notion that the 10-year yield has been pricing in and warning about the possibility of a second wave of inflation emerging, or at the very least, a prolonged and more challenging struggle against the persistent service sector of inflation. And then I continue on. When you begin examining the inflation rate expressed as a 12-month, 6-month, 3-month, and annualized change, it suddenly becomes plausible that a 3% floor could be established. Although the trend hasn't completely flattened out yet, it's possible that there's a lower high could be discovered on the next 3-month annualized rate. Even after the recent increase in annualized rates and the flat month over month data, the Fed tracker tool now predicts higher chances of a December cut as of Wednesday's meeting or Wednesday's closing. Odds shifted from 58.7% probability of a 25 basis point cut in December before the CPI release to 82.5 probability of a 25% or 25 basis point cut in December after the CPI release. And there's a chart that kind of shows this. It was only after Jerome Powell mentioned in his commentary on last Thursday, that the FOMC is not in a hurry to cut and will remain data dependent, that the odds, fell back down to more balanced positions for December, I guess. I mean, who knows? The current probabilities stand at 59.9%. This seems more appropriate considering the evidence mentioned above, our previous conversations and analysis of the elevated 10-year yield, and the fact that Powell has indicated that the FOMC will remain data dependent. A good practice after developing a thesis is to try to find supporting evidence against it. It would be quite disappointing to overlook something that would have been evident in hindsight. To that end, we are nothing that wages have technically outpaced inflation. This doesn't imply disinflation, but rather suggests that inflation's impact won't be as pronounced relative to the inverse relationship. As always, this provides us with a fundamental understanding of the market's underlying condition and area of concern. Inflation will remain a highly sensitive topic for the upcoming few CPI cycles. However, technical charts play a crucial role in guiding decision-making processes. So let's examine the key factors influencing the market this week. There's a chart right here, right? Wage gain and all this stuff. But the next thing, the broad market analysis. The S&P 500 weekly chart is retracting its steps from the highest point of the trend count. It has currently reached the prior all-time high and is resisting the high volume node, the HVN, high volume node. Ideally, it should provide support there. If not, the weekly line in the sand, which I've discussed many times, remains at on SPY 565 area. This area is reinforced by technical confluence here. I mean, you can see the photos and everything. The S&P daily or the SPY daily chart. Let's keep things simple this week, okay? Either we avoid the election gap, which that did not take place. We filled the election gap today. Or we close. Or maybe that was yesterday that we filled it. Whatever. Or we close it. A move over or under 586 on SPY will give us a clearer picture of what's happening. However, the gap and go on Friday, this past Friday, does leave some room for improvement for buyers. The SPY hourly chart, pathing is where we have some fun with the potential for daily lower high threat during the gap fill revealed at 592.75. Despite this, the overall trend remains bullish due to the supporting evidence. Therefore, we're trying to align our strategies more closely with the long-term ideas. We're open to the possibility of shorting the market, but the white path in this chart right here, okay, the white path offers the greatest potential for significant risk to reward ratio. Will set the daily lower high at the gap fill reversal of 590 to 75, and then look for an equal low breakdown at the 586 area. From there, the election gap gets closed, becomes a key factor to consider. Market internals don't reflect stronger sellers at the exchange level, driving more volume into the stocks. However, note that on Friday's session, when the market was at its lowest, the internals were technically more bullish than on Tuesday. And I'll just pull this up. So it's all whack. Market profile, poor highs and lows galore. I would love to see a repair of the lows so that we can get back to the highs. This aligns with looking into the election gap, the failure of the sellers, and the rotation back higher. Testing the highs first will get bullish acceptance back into the range. And that's what this is right here, people. Real quick. Dollar and rate soar spot. The financial conditions are tightening up. Our argument is that paper assets will inflate if wave 2 of inflation arrives. A pullback reversal is welcome here. Prove the arrows wrong. See? And I'm going to keep going. Okay, almost done. Economic and earnings. Pretty quiet this week. Just one Red Star event. Building permits. And that was this morning. Building permits provide insight into the cyclical nature of the economy, although they are not as closely, monitored as inflation and labor metrics. But you should pay attention to them. Obviously, here's the earnings of the week. Tomorrow we have Walmart in the morning, Lowe's. We got Medtronic, Futu, and then in the afternoon we have Powell. I mean, Dolby. I don't even know a lot of these companies. Honestly, I don't care. Doesn't matter. Swing stock scans. Well, I'm not gonna get into that right now. Y'all have access to that. But Gecko, what do you think about my thesis? Gecko, I'm waiting on you. Can you hear me? Answer me. I want you to tell me what you think about my thesis on everything. What is he doing? One second. All right, Gecko, are you able to give me what your thoughts are on my thesis of everything we just went over about the commercial real estate market and what's going on in the market in general?
Absolutely, Chuck. Your analysis highlights some critical issues in the commercial real estate market. Oversupply. With a substantial amount of office space in inventory and more under construction, the market is facing an oversupply issue. This leads to increased competition among landlords, driving down rents and property values. Declining demand. The net absorption rate's decline indicates that more space is being vacated than leased. This, coupled with lower leasing rates, shows that demand for office space is weak. Increased vacancy and availability. Rising vacancy rates and high availability, both indirect and sublease space suggest that companies are downsizing or opting for remote work, leading to more vacant office spaces. Loan origination and delinquency. The decline in loan-to-value ratios and the rise in delinquent loan balances indicate financial stress in the commercial real estate sector. This could lead to more defaults and put additional pressure on lenders. Interest rates. Fluctuating interest rates impact borrowing costs and investment returns. The recent rise in interest rates can increase the cost of debt, affecting property owners' ability to refinance or service their loans.
So can you explain to the Bag Brigade fam that when they cut rates, why did the 10-year yield run to almost 5%?
Certainly, Chuck. When the Federal Reserve cuts interest rates, it generally aims to stimulate economic growth by making borrowing cheaper. However, the relationship between interest rate cuts and the 10-year Treasury yield isn't always straightforward. Here's why the 10-year yield might rise even when rates are cut. Economic outlook. Rate cuts can signal that the Fed is concerned about the economy. If investors believe the rate cuts won't be enough to boost growth or stave off a recession, they may demand higher yields on long-term bonds as compensation for the perceived risk. Inflation expectations. If investors anticipate that rate cuts will eventually lead to higher inflation, they might demand higher yields on long-term bonds to compensate for the expected decrease in purchasing power. Supply and demand. If the government issues a large amount of debt to finance stimulus measures, the increased supply of bonds can push yields higher as the market demands a higher return for absorbing the extra supply. Global factors. The 10-year yield is influenced by global factors. If other major economies are performing poorly, or if there's geopolitical uncertainty, investors might flock to US Treasuries as a
What? As a what? Mm-hmm.
It acts as a safe haven investment. When there's uncertainty or turmoil in global markets, investors often turn to US Treasuries for safety. This increased demand can affect yields, sometimes pushing them lower even when the Fed is cutting rates.
Well, no, the yields went up when the Feds cut rates. What are you talking about?
You're right. My mistake. When the Fed cuts rates, it can sometimes lead to a rise in long-term yields, like the 10-year Treasury, for a few reasons. Expectations of economic growth. Investors might anticipate that rate cuts will eventually stimulate economic growth, leading to higher inflation and interest rates in the future. As a result, they demand higher yields on long-term bonds. Increased borrowing. Lower interest rates can encourage borrowing and spending. If investors expect a surge in borrowing, especially by the government, to finance stimulus efforts, they might require higher yields to compensate for the increased supply of bonds. Shifts in
I mean, who are they giving stimulus deals out to, man? Like, that was a joke. You know, I got one too, but I got multiple of them, but it was nothing life-changing whatsoever.
The stimulus checks were meant to provide immediate relief, but for many, they weren't a game changer. While they helped cover essential expenses for a short time, the amount wasn't enough to create significant financial change for most people. The broader economic challenges require more comprehensive solutions than one-time payments can provide.
Yep, I agree. And that was a little test run of, the continuing Bag Brigade that we're gonna do. I'm just going to put an outro music on. Do you have anything to say to the audience before we leave?
Absolutely. Back Brigaders, it's been great sharing insights with you. Remember, navigating the markets requires staying informed, adaptable, and resilient. Keep learning, stay disciplined, and let's tackle whatever the market throws our way. Until next time.
I like that. Now I'll go with mine. I know you heard mine last time. You remember what I said last time?
Yes, you said, we don't count the days anymore, we make them count. It's a
didn't-
powerful
I
message.
did not say that. I don't know where you got that from.
My mistake, Chuck. What was your sign-off last time?
Well, I had two sign-offs. One of them is a little vulgar, and one of them is the truth. So I'll just do it again. Bag Brigaders. Holler at the tiz. That's me. For honor. To getting on her. To staying on her. But if you can't come in her, come on her.
That's quite the sign-off, Chuck. Thanks for sharing your insights with
I'm
the
not
Bag
done
Brigade.
yet. I got one more.
Got it. Go ahead with your last sign-off.
And this is something that I live by. I made something out of nothing. ... Thanks for fucking nothing.
A strong statement, Chuck. It speaks.
Excuse me.
No problem. If you need a moment, take your time.
No, go ahead. You're good.
All right, Bag Brigaders. It's been a session packed with insights. Remember, the journey in the markets is all about learning and adapting. Until next time, stay sharp and keep pushing forward.
Yeah, man. Words of wisdom from the man himself. So what I'm going to do is we're going to end this on this.
Sounds good, Chuck. Looking forward to the next session.
Do you
Take
remember
care.
first time you heard the legend in leather? The career ended with the roadkill and stopped to his fender. I'm on another bender, drunk off the power to make a coward surrender as I devour contenders. Talking foul of whoever, your head is about to get severed. Then about to with pleasure, I'm pouring out, I'm a redder. Homies, I won't forget them, so tap the bottle and pour it. Supermodels, I ignore them later on, it's like pouring reincarnation of the Ripper. I give stitches and chest zippers. Cinderellas get propelled out their glass slippers. Time is ticking, giving ass whippers. How we keep the cash slipping.
I can't understand a single word you're saying. I think you have syrup brain. About to finish you like polyurethane. All that Molly Polly sure to drain your spinal fluid from your vertebrae. Just a murder
Thanks,
gram. I
Chuck.
brought my murder
I
game.
appreciate
I should
it.
fire that is why
Until
you log
next
on it
time.
like Duraflame. And as far as boulevards, I'm talking about farmers like insurance claims. I just blew your girl away, but she on so much blowing lean. I call that fucking hoe Katrina. Somebody better give her a cane.
And that's on everything. She love my heavy chain, my yellow diamond shining. Got a